Hello and welcome to another episode of the Swing Trader Status Update. It's Justin Nielsen here, your host, and it is March 18th, 2025. We're going to get a little bit back to the basics as we uncover what's happening with this market ahead of a Fed tomorrow. But to help me break it down, it's Mike Webster joining me as he does. Senior Market Strategist. It's, I think, the title. So I know I always struggle with it.
I've been promoted to random dude out in Austin.
Yeah. So Mike, a lot to talk about today. I mean, just, not much activity that we've been doing on SwingTrader, but that is by design. That's a feature, not a bug, folks. So let's get into it a little bit. But before we do, we have some kind of news for you.
Is Sammy Hagar doing a world tour with?
Right.
Oh, okay. Yeah. So going forward, Justin and I are swamped with a million projects, and frankly, there's just not enough time in the day to do everything that we need to do and do it at the level that we need to do it. So I've decided that we're going to do this once a month instead of weekly. I really know that there are a group of folks who like to watch it weekly, and we do the SMT videos daily, and I do the ones on Friday, sometimes with Justin, most of the time with Ali, and of course we're on IBD Live. I'm on IBD Live Monday, Wednesday, and Friday, and you're on which days? Or
Mondays and Thursdays usually.
Mm-hmm. Yeah, so there's plenty of us on. Probably most people are sick of hearing me babble on. But we're going to, until further notice, change these to the second Tuesday of every month, because I thought it would be fun to have it as an ST, second Tuesday, Swing Trader Update. So the STU, because that's fun and all. So we're going to do that. And so thank you for watching, those of you who watch every week. It was a hard decision, but we've got some important, really big things that we're working on for Market Surge as well as IBD, and there's just not enough hours in the day.
With some deadlines as well.
With deadlines. And so something
deadlines.
Yeah, something had to go, and this is one of the things that had to go. So,
and again, just to be clear, it's not going away.
Yes.
It's just reducing. So we're going to be going to a monthly. So our next show will be April 8th, since that is the second Tuesday of April. So
and if one of us is traveling on the second Tuesday, because I really like to do it with the two of us, if one of us is traveling, then we'll either bump it forward or a day or two or a week or whatever. But that is going to be the game plan, is the second Tuesday of every month.
So, okay. So with that out of the way, with that announcement out of the way, and again, as we always say, we really appreciate everyone kind of coming on and hanging out with us. It's nice to see in the YouTube comments a lot of familiar faces, I guess, or familiar names at least. And so again, we're still going to try and give you as much as we can. And for those of you that are members of the SwingTrader product, we're going to be communicating as we always do through alerts and everything like that. And hopefully at one point we can do something a little bit special for subscribers, but we're still working on that. And there's other pans on the fire, or other irons in the fire at this point that we have to get
everything is in that fire right now, man. With deadlines.
So let's go ahead and get to the market, because a lot of folks are kind of wondering about how quickly we came down. I mean, a lot of people were looking at this. We very quickly hit a 10% correction on the NASDAQ and on the S&P 500, probably at the fastest velocity in recent history. I mean, you have to go back to the COVID crash in 2020 to kind of get a drop that sharp that quickly. But now that we've kind of done that, it's a lot of people are looking for the bounce, and that's certainly what we do. We kind of go into that phase of, okay, the market's in a correction. When do we start buying again? And of course, one of the things that we do that we both learned from Bill O'Neill, the founder of Investors Business Daily, was the follow through day. The concept being that we start with a rally day and then we look for a confirmation of that rally strength. And because you have those 2 points, you can kind of say, this is a potential uptrend. Now, it doesn't always work, but it at least gives you a signal to work off of to start your buying. And until you get that, sometimes we are a little bit more hesitant to put on very heavy exposure, or at least keep very heavy exposure for very long. So just to kind of go through some of the stuff that happened recently is we did have a low happen on the NASDAQ. We had a rally day. Let's see, this was on Wednesday of last week. Now, Thursday, we came down and we got below the rally day low, but we didn't undercut the low of the rally itself, just the rally day. So these are 2 different lows here. And I will say that for those of you that, listen to Bill for a long time, sometimes he did switch back and forth. Sometimes he would say the rally day low and mark the chart that way, and sometimes he would use the ultimate low of the rally. We did nail him down at one point and said, look, Bill, you got to decide one way or the other so that we can teach people going forward. And the way that he decided was, that the rally is not dead until you undercut the absolute low of the rally. The NASDAQ did not do that. It got 1 point away, but 1 point is 1 point. And so because it did not undercut, the rally is still intact. Yesterday was a day 4 for the NASDAQ. We did not get enough of a gain there. It wasn't enough strength to qualify as a follow-through day. So that didn't count. We're still counting. Today does not look good in terms of how things are, but you could still get a rally, a rally tomorrow. And if it is of sufficient strength, that would qualify as a follow-through day. Now, the S&P 500, it did undercut, because on Thursday, it undercut just slightly that rally low. We had to start the count over there. So we started with day 1 on Friday. Now we're at day 3, and tomorrow is the first potential day that we could see a follow-through day on the S&P 500. So even if we had a lot of strength on Monday on the S&P 500, wouldn't have counted as a follow-through day because it was too soon. So we want to make sure that a lot of people who maybe weren't familiar with our follow-through day concept had that down, because that's one of the things we're looking for. It doesn't mean we can't do any trading before that happens, but it does mean that you generally are keeping your trading a little bit less. So with that being said, Mike, that's the NASDAQ and the S&P 500. How are you looking at things now? I mean, the S&P 500, we kind of got up to that 200-day moving average line, or not even touching it. But I know you've been bringing up on IBD Live the strength in the New York composite, NYSE composite, not something that a lot of people look at.
Yeah. So, wow, you did a great job with the follow through day summary.
I was saving your voice.
It would have. I was thinking the whole time. I'm like, it would have taken me a half an hour to say what you said in 5 minutes. So, great job. Perfect summary. People should go back and listen to that if you're new to follow through days. Even if you're not, just a great refresher. Perfect job. So, this one is your strongest one. But let's go back to the as we were going to talk about the basics, and then we'll circle back to this. Let's go back to the NASDAQ, because since that was the one that was alive and potentially looking for a follow through day, that you always look at the very specific things like a follow through day, and understand the mechanics of how they work and everything. But then you also have to step back and look at the position that you're in, to understand, are you in a position of strength or weakness, and the odds stacked with you or against you, and they're really against you for a lot of basic reasons. So let's just kind of go over them one by one, and not in any particular order. But starting off the top, that red line is your 50-day, and we're a country mile away from that, which is a spooky thing to be under, because the market allowed it to come down here. Now, when you're really far underneath the moving average, it's also a spooky place because you can have a mean reversion. Like moving averages, they're averages, and markets and stocks like to revert back to their average. Whether you're looking at a 5-day average or a 50-day average, they tend to, in that space, go back to them and then trend, either trend slightly above them or slightly below them. But when you're this far underneath it, it means that there is a material shift in the market. Then you go to the next thing, the 21-day, the green line. Same thing there. Now we've closed that gap in a fairly big way from how far we were apart from that 21-day when we're at our lows versus at our highs yesterday. So that did fixed a few things in a little bit. It kept us from a massive mean reversion. Lots of people would call it an oversold. Bill O'Neill was not a fan of the word oversold or overbought. And so the two of us don't like to use those terms either. But I know that's what people think of. But when you're
And the reason he didn't like it, just so people understand,
yeah,
is, because when you say oversold, a lot of times people think, oh, well, it's done.
yeah.
And the reason he didn't like it is because he always was very adamant that, look, just because it's oversold doesn't mean it can't get more, that the pain is over. It can get more oversold. And so he didn't like the definitiveness that people often used when they said oversold. So,
Yeah, and I agree, and I think most of the indicators, not all, but most of the indicators that people use for oversold and overbought or psychological things like bull bear, they all have big problems. Some of them have massive problems, but they all have big problems. Some of them have the problems size of Texas, and we don't have time to go over them. So you want to keep it as simple as possible and just look at the price, and with the price comes averages. Now, the next thing, and probably the most important of them, if you were going to put a priority on them, is the 200-day. We are now living underneath the 200-day. So you're not always just looking at where you are in relationship to it, meaning your close, is where's your high in relationship to a moving average? Are you, and we're well underneath it, and we've been underneath it for a long time now. So we're starting to live below all of these moving averages, which is a trend in itself. Just like when we have a power trend on the way up, we treat the market a certain way. When you're in this, I don't want to say a power trend on the way down, because that's a big can of worms and more complicated than most would think, because markets don't go down the same way they go up. It's a different animal. But we're in this position where it's very weak and very vulnerable for position trading and swing trading. And it's been so choppy. Like if you look at each one of those days in this decline since we broke the 50-day, you've got big swings. So that's telling you that the market has not settled down yet. And when it settles down, you'll notice it, because the spreads are going to tighten up. So the distance between the high and the low, and if there's gaps involved, that as well, that'll start contracting, and that'll tell you that the market knows what it's doing. And right now, the market doesn't know what it's doing. I mean, think about the difference between today at its low versus yesterday at its high. I mean, what had materially changed? Nothing had materially changed, but the prices sure did. That's because no one knows what to pay for them. I mean, everyone's trying to catch a bottom or trying to, short more. And, it's a very risky place to be short, because the normal and natural thing to do would be to move up to the 200-day, that black line. And that's kind of my base case, is go up to the 200-day line and then come back and test some part of this. That would be the most normal and natural thing. But we have a big event tomorrow. We have the Fed, of which no one expects them to move interest rates at all tomorrow. Like that would be, the most surprising thing ever. So no one's expecting that at all. But it's all about not only what Powell says in the statement, what changes are made, but what changes are made to the dot plots, as well as how does he answer certain questions during tomorrow's press conference. And that's very late in the day. So until we get through that, and how the market really reacts, both on Wednesday, but really on Thursday and Friday following that, once everyone's had a chance to absorb that information, I mean, it could be a game changer on the way up or the way down. I mean, go to the December 18th date and just point that out. Like that was the last big Fed announcement. I mean, we've had others since then, but that was all because of the Fed and their change in their kind of their stance. So that was a material move down. Now they
And just
theoretically,
to be clear, in terms
yeah,
of the action was so there was no change in that regard. So yeah, it's just a funny thing.
yeah. Well, your funny thing, you went black. Your screen went black when you said the funny thing. What was it that you said?
Oh yeah. So the funny thing is that in terms of the action that was expected, it was exactly as expected in terms of the action. You know,
Yes.
what the Fed did, but again, it was the comments in the press conference that really kind of swayed things, and yeah, it's just again, you might get the expected action tomorrow, but then one comment can throw things. And this is something else that Mike and I were talking about. Is the scary part sometimes is again, everything might be as expected. Even what he says might be as expected, but the algos kind of pick the words out, and then they say, "Okay, well, this is, this is bad," and so they start running. People start saying, "Oh, maybe this was worse than I thought." They start selling, and you get something that can easily feed on itself. An information cascade is what it's called.
Yeah, exactly. And so the mechanics are, the statement comes out before the press conference, like a half an hour or whatever it is. And within a millisecond, the computers, the algos compare the two different words or the two different, the last statement as well as this statement. They see what's different and then they decide whether to buy or sell in mass. And then no human is involved with that. And so we're all thinking a certain way, but the computers are different. They're reading certain words and they're saying, see more hawkish or more dovish or what have you, and the dot plots and all. And so there's going to be most likely a lot of volatility during that time, and that's why we like to wait until the Thursday and Friday after it, because after the press conference, because it allows all the humans, the portfolio managers and analysts and everyone in between to review what was said, to look at things and make adjustments to all their evaluation metrics and everything, and then decide what they're going to do on Thursday and Friday. So we're at this point where it's another one of these big risk events in a really, really bad position. Now, we are in a position where we always talk about the 50% retracement. So we went basically from 20,000, give or take, down to, 17,000 and change. And so half that distance, you can move up half that distance and still be in a downtrend. Because the way I look at things is you're still in that trend until you can go above that 50% retracement and start living up there. So really living in the 19,000 or so, that's a long way from here. And that's when you know that this trend has changed. So the trend is down. We're underneath our 50. We're underneath our 21. We're underneath the 200. So the trend is down, but we are in a position where a snapback, that's what I'm scared of, is a snapback, and we'll have to take action, on it. But let's just go to 2018, because that's
Okay.
the thing that I know I've been talking about it a lot on.
Well, you know what I was thinking? Do you
Yeah,
want to show your Webby RSI
yeah,
in
let's
terms
do
of that
that.
level of extension?
Yeah,
Just because, again, you mentioned before we get too far away from it, you mentioned that level of extension to the downside where we had a lot of the, we're comparing the high of the day to a moving average line. And this is what your Webby RSI does. Now, when it's blue, that's saying basically that the low in relation to the 21-day moving average line, how many ATRs are you up or down from there? And so the blue is when your low is above it. The orange is when your high is below the 21-day moving average line. And all of this is in terms of ATRs. So you can see that just a few days ago, we were up, and I think we were talking about this. We were up at the 3 level. That was kind of a level that you have a line in the sand there. Once you get 3 ATRs below your 21-day moving average line, What does that tell you, Mike?
Yeah. So this started off as measuring just on the long side, with the blue stuff. But then as I was messing with it and switched it to ATRs, I'm like, there's really something here too on the downside, and it works kind of in a lot of ways in mirror of it, but there are some differences because, as I said before, the moves down are different than the moves up. The moves up tend to be more trendy, and the moves down tend to be more abrupt. But still, when you get to the extremes, they want to mean revert. So on the upside, when you get up to 3 ATRs with your low above the 21 day, it tends to want to mean revert, meaning coming back in. The same thing on the way below, and that's why I've got that red line there at 3. So we got up to it, and on the bottom day, and that was at that point it was like, okay, don't short anymore, don't put invert, don't trade inverse ETFs, things like that I was doing personally, and switch gears to more neutral or long, because the base case then is a mean revert up to, not always up to the 21 day, but at least closer to it. And so that now we've done that, and you can see that with the bottom of the histogram there. Now we're, like 1.75 ish or so ATRs, underneath it. So that's more neutral. It's not an extreme level, but it's still a weak level. So this is another reason why we're sitting on our hands, because we're in no man's land. Like, there's no edge, and if you don't have an edge, you don't want to trade, because then you're just gambling. And we don't, we're not here to gamble. We're here
Mm.
to put on an edge. Doesn't mean every trade is going to work out. I mean, they just, that's not the way the world works. But at least you want to have an edge and an expectation. Right now, there is none. Um, and so let's look at the SPY as well, just to kind of get a sense. And that one was similar to that. It got up near 3 and came back. But we're going to go back to the NASDAQ and just look at the last time this was over 3. That was back here on August 5th, when it came down sharply. And what was normal and natural there, when you come to an extreme level, is to mean revert. And that's what happened here. It went right back up to the 21 day, and then carried on from there. We didn't do that here. And let's just go back a few, some other times where, back in the 3 waves down that we had in 2023. This is in the starting in the July timeframe. You kind of spiked up. You didn't quite get up to a 3, and then you went back up. This was more normal for a 3 waves down, and you can just study it over time. But the one that I was looking at earlier today that kind of spooked me a bit was back in this is in 2022, and the two of us were talking about 2022 earlier
Yeah.
today. And you came down, and you're about 3.5 ATRs away from your 21 day here, right up in here. And then you mean reverted, but you were still in that chop area, and you saw what ended up happening the rest of that time. And so that's really what we're concerned with, that having that mean reversion. You can see it back here in in the COVID crash that happened. You got some extreme levels, so we're not there. But this was the one that the 2018 that I was talking about before. That and people should go back and study this. Is in the fourth quarter of 2018. You got this extreme level up to a little over 3.5. So you started mean reverting, and you didn't get all the way up to the 21 day. Then you rolled again. Then you got some follow throughs in here, another follow through day in here. But essentially, this 3 waves down, and it didn't clean itself up until here on January 4th, when all was done. And you could see at that point, then you got back above your 21 day, and you started trending nicely, where you had this wall of blue here for a long period of time. So that's why this is what we're thinking is a base case. You got up near your 200 day right here and failed, and got up near it again and failed. So that is kind of normal and natural. When you're underneath the 200 day, you are in like scary territory, and you need to be very, very careful. It's kind of like you're driving through, a city you don't know, and you get off of a freeway, on an exit you shouldn't have got off of. It's like, man, you know, be careful. Like, it's a time to be really, really careful. You're underneath the 200 day. You like, you're in the hood, man. You want to get out of there, you know, or just lay low. And so that's kind of what we're in. We want to get back above that 200 day, start trending above it before we start, you know, putting on the gas. I think I could stop sharing this, or was
Yeah,
there
yeah, yeah.
anything else? Okay.
Nope, nope. That I think again kind of really lays it out. Again, you can see that that 3 ATR level is certainly one of importance, but you can get way above that, and that's kind of where we're at right now. Is we did resolve that portion of it, but that doesn't necessarily give us our clue for the next step. I think we had the feeling that okay, yes, a bounce would have been expected here. The ATR is getting up there in terms of its extension, but now that it's resolved, it's kind of a little bit more of an unknown, especially ahead of a Fed day, which is again another reason to be a little bit more cautious right here. But I wanted to make sure that we did get a chance to kind of cover. Oh, and by the way, this is that 2018 time period that you were looking at. So you saw that the ATRs got a little bit extended here. Below the 21-day moving average line, you got your bounce, but then you had another leg down as we were still kind of working through a lot of that Fed. What's the Fed going to do type action?
Yeah, and I would say with that one, people should really go back and do it day by day. It won't take you that long. You know, it's only a quarter. You know, he's a little bit more than that, but go through that and focus in on the 200 day and focus in on the 21 day. And once we started trending above that 21 day, even though we were still underneath the 200 day, it was a different situation. So 3 days with your low above the 21 day, and being up on the day, that is kind of a game changer in my mind, even when you're still underneath that. But you can see how big of a deal that was, right? You know, you get up to your 200 day, you close above it, you've got to take action on that day. Like, even though knowing that the odds are stacked against you, you got to take some action, because sometimes they just keep going, and you don't want to be left in the dust. But I don't mean to be a Debbie Downer, but it's just, this is not the everything that the two of us have studied, you know, because we went through, when we were creating Market School with Chuck back in 2010, 11 timeframe. I mean, that's all we did is study the Nasdaq's history day by day. And this is the time where really weird things can happen on the
Yeah.
upside and the downside. Like,
Right.
you know,
So you
I was
can't get too negative either. You
no,
have to remember that there is that case that a follow through day could happen any day now. And that would kind of suggest, okay, maybe we do need to get a little bit more cautiously bullish.
yeah, and really it's more of a, like, from a snapback standpoint, right?
Yeah.
Because now there's another thing that
And
seems to
I'd
be
almost say that's where swing trading has an edge to a
yeah.
degree, because if you do get that snapback, you can kind of participate in it. Maybe do some selling into strength, as you've been seeing us do lately. GDX is a good example of that. Selling into that strength. I also, some people were asking about the column, whether the column write up was going to be switching. That's going to continue to be a weekly column. This last one was on GDX. We did kind of talk a little bit about you and I, Mike, about working through some different scenarios. So definitely check out that article. You can get to it at investors.com. Go to the research tab, swing trading, and we talked a little bit about how okay, when you're taking profits into strength, how that can kind of help improve your worst case scenario. Raising your stop helps improve your worst case scenario. So I think that sometimes in these bounce backs, snapbacks, you do have a little bit of a benefit if you are taking a shorter term um, time frame for those trades. Now, it can work against you if you have something where you're doing a short term time frame and things just rip from there, and you're selling into strength. You can lose your positions, and it makes you have to chase a little bit. But overall, I think there's some benefits to the shorter term time frame in that regard.
Yeah, no, I agree with everything you said there. And again, our base case scenario is really like that 2018, and that means a move back above your 200 day. So that's a long way from here, you know. And so we will be trading on the way, you know, if we start moving, you know, through yesterday's high and everything, we're going to be, you know, increasing exposure, because we're not going to tell the market what to do, but
Mhm.
we're going to do it in a careful way, meaning not super high ATR stocks unless they have a very clean and tight stop behind it. And that's another reason why we didn't put things on over the last couple of days, is because they're really I mean, we put a little bit on, but nothing material, because there wasn't a clear exit. You didn't know. Right now you don't know that you're wrong until you take out the lows from, you know, our low, what, 3-4 days ago. Like, that's a long way down from a swing trading standpoint. So if we had had an upside reversal at the bottoms, then we would have tried a bunch of things, because then we would have
Kind
had
of
a
like what we were
clear.
seeing right here. It
Yeah.
just we were getting our upside reversals, but there was just no follow
Yeah.
through at all.
Yeah. Well, why
Yeah.
don't we look at some of the things that are working? Like, let's look at
Well,
cable.
just real quick
Oh,
before we
yeah,
move on
sure.
from here, I wanted to kind of address two things. Number one,
Sure.
you said how we still have quite a distance to the 200-day moving average line. Not so much with the S&P 500. It did get a little closer on the S&P 500, and notably on the equal weighted S&P 500 RSP, we got right up to that 200-day moving average line, and then today we kind of came in. And then I also wanted to give you the chance to kind of talk a little bit about the
Oh, yeah,
New
that's right.
York Composite. Wanted to get back to that because that got above the 200-day moving average line and is looking in a like just a very different position.
Yeah, kind of night and day, because again, just going over the basics, you're above your 200-day. Not only that, your low is above your 200-day for 2 days in a row. We have an inside day, in a tight constructive inside day, though. Even though we were down 0.38%, we held most of yesterday's move and the majority of the 2-day move. So that's a huge win right there. With your low staying above it, you're very close to your 21 days. So the Webby RSI on that would have been looking fine. It still would have been negative because your high is underneath it, but not by a material amount. And your 50-day is flat. So this looks like it's forming kind of a base next to a base. Like, it had a little cup with handle that it broke out of, kind of stalled around at 20,240, and then came down. So it looks like the left side of a base. Now, the bad part about that is it's very unusual to have a base like this just pop straight back up to new highs. Typically, this would either be like the first leg of a double bottom, or it would need to round out. It's just a little bit unusual, but not totally strange. Where, I mean, we could certainly move back up to the 20,000 in some fashion and still be, look okay. But normally you need more time. When you've come down this much in a short period of time, you need a lot of what Bill would call like backing and filling, which is just testing. It's testing the bulls, testing the bears, and so on. And then they have to find an equilibrium and then move in one direction or another. We hope moving on the upside. But what is important about the New York Composite and how different this looks than Nasdaq, it's telling you where the money is flowing. The money isn't flowing into the large mega caps. Why don't you pull up like the FNG, one of those, the FNG? What are they now?
FNGS
Yeah.
is the fangs.
Yeah. So this one came underneath the 200-day, kind of like lifted up to its 200-day, ran into resistance there, and then came back down. I mean, it doesn't look like much, but that was down 2% today. That's a material amount, like that's and it looks
Especially
like.
considering how many of these are, market caps above a trillion, right? So
Yeah.
2% when you're at a trillion, that's not chump change.
Yeah. So to me, it really feels like there's this liquidation of, in ways it is reminiscent of 2000, in that where money was moving out of Nasdaq and moving into the S&P and Dow type of stocks during that time frame, because people knew that they had a lot of risk, in the dot com type of names, and so they were selling those, and they didn't want to go to cash, so they were moving, or they weren't allowed to, depending on their mandate, and they were just rotating into other stuff domestically. Now, it feels different, because rather than the money moving and staying within the US, this time it feels like it's moving out globally. And so I have a position in this. This is basically the market the world market excluding the US. And a decent base here, and it's broke out and it hung in there today. I mean, I wish it was up today, but it's not down in any real way, and it closed back
It,
up.
it looked very different from everything else, and you see that relative strength really kind of skyrocketing.
Yeah, let's go to the monthly on here just to kind of give, because it's not something we normally look at. And you can see, you know, while the S&P had been going up, this has been, really just going back and forth sideways. This is everything else, the rest of the world. Can you turn off your best? Is your best fit on by any chance?
It might be. There we go.
Okay. Yeah, so it's just choppy, just going back and forth, and you can see that the RS line has just been going under for a long time. So put your hat on, and let's say you're running a big mutual fund with like 100 billion plus, and you're allowed to trade outside of the US. Well, you're probably going to be like, let's say you're allowed to trade 15% of the account outside the US, you're probably going to max that. Whereas in the past, you probably had that at whatever the minimum level threshold that you were allowed to do. So it seems like the marginal dollars are going outside the US, whether it's, you know, Europe or China or, or other parts of Asia, but it's not, everything's not working. India wasn't, working, and we saw Argentina get hit today. So it's not just like throw a dart at things, but it does feel like, outside the US has the wind at its back, versus here. And why don't we go to K-Web, because that is how we were trading China. And like I said, I do have a position in this one. And this one is a more on the risky side, obviously, because you're dealing with a single country versus the rest of the world. And there's political risk there because we don't know how President Trump is going to be handling the tariffs with them. But this is in as good of a position as you can be. And it looks like it wants to move higher. Now, the thing is, because it's volatile, you can't have a big position there in a comfortable and be comfortable with it. But this RS line is smoking, and it just feels like the money is still gravitating there. Versus like within our market, like let's pull up like KIE, for example, the insurance companies where like people are hiding right now. We could have done the play of moving into insurance stocks, or really heavy gold position. We have a minor gold position now with the GDX, but it's only a quarter position right now. But we could go heavy in the slow pokey names. But what's been happening is one by one they would break out and fail, because it's kind of a whack-a-mole type of situation where anything that pokes its head up, institutions are like, okay, I'm going to book these profits, and then that comes back down. So if the market does a mean reversion trade, meaning the Nasdaq bounces up to its 200-day, most likely these slow pokey stocks and groups that have held up are going to at best go flat, or probably start going down as the money flows out of them into either short covering rally or what have you. So it's not as easy as just rotating into those right now, because when you're underneath the 200-day, it's a completely different um, book that you have to, different rules you have to trade off of. And now's the time to be light, in my opinion, and to stay light until things materially change.
Hmm. Yeah, totally makes sense. I'm going to stop the share here, and I'm going to switch to our charts that we show for all of our episodes. And so we've got a little bit of a difference here. For the longest time, it seemed like we were just having our big blue dot. We still have a very heavy cash position, but as you mentioned, we do have that position in gold. We do have our position in international, and there is the position in K-Web. So we're kind of, we usually don't completely show our hand for these, but there's going to be a lot that can happen between our next one. So again, that's something that subscribers will be getting through our alerts. But this is where we stand right now, as opposed to how we've been in cash quite a bit. And you can see that on this chart, we do have 50 days now. I told you how there were a couple weeks there where we had gone to a 50-day performance chart here, a rolling 50-day performance chart. And then we were doing some stuff with our spreadsheet. So it was year to date for a little while, but now we're back to our 50 days. And you can see that, really and since February 21st, when we really cracked that 10-day moving average line on our equity curve. This purple is our equity curve for SwingTrader. And what I do is I just basically say, okay, 50 days ago, let's index them both at 100 so we can see where they're at. The purple is our SwingTrader equity curve. The black is S&P 500 or SPY. And then we've got moving average lines on our equity curve, the yellow being a 10-day and the blue being a 21-day moving average line. And then below here, we have our invested percentage. Here's our 50% level. Here's 100%. So you can see that right before we were getting a little bit on margin in February because, hey, things were working. We were trending above our 10-day moving average line. So we had a good outperformance versus the S&P 500. So it made sense that we were pushing it a little bit, going on margin. But then as soon as we started coming down pretty hard, we did get very defensive. And we haven't gotten above 50% in a month's time almost at this point. And look, this is again where for folks that are subscribers, you might be saying, well, did they fall asleep? But are they still alive? Well, this is where you get outperformance is you let the index come down. You don't take the temptation to trade when you don't have an edge. And so we've been going flat here. And that actually allowed us to catch up to our 10-day moving average line.
Yeah.
And so now we're back above our 10-day moving average line, whereas the S&P 500 has really kind of suffered. And now you can see we've got a nice gap in between. And if we switch to our relative strength line, this is our relative strength line and a moving average on our relative strength line versus the S&P 500. You can see that we really picked up the pace in terms of our relative strength over the S&P 500 by basically not getting tempted to try and play every single bounce that's only lasted a single day. So any comments on these charts, Mike?
Yeah, I would suggest people do this themselves at home with their own account. Probably the best thing that you could do. And if you're not comfortable with Excel or whatever, just go on YouTube and find some stuff.
Yeah, a lot of people have been it's funny you say that. A lot of people have been saying, okay, can you give us your template? And it's a little bit tough. First of all, you have to have your equity curve, so start there. And I think what I'm going to do is I think I'm going to do a video and just share the different formulas that I use to kind of get a 50-day rolling. At the end of the day, it's really about having just your value, your portfolio value. And the one thing I will just caution folks is that if you're going to do a portfolio value, make sure that if you are adding money or subtracting money, that you are accounting for that. Because that's the old Beardstown ladies. You remember that? What was that? 2 decades ago, where the Beardstown ladies were showing this phenomenal performance, but they had neglected to factor in that their dues were adding to their portfolio, and they weren't kind of normalizing that out. So it overstated performance. They still did a great job, by the way, but it overstated their performance. So you have to. That's going to be everyone's homework. Make sure you've got your equity curve in terms of just. It can be a simple dollar amount. We'll talk about indexing later, but just get that simple dollar amount, and from there you can do some indexing. And again, I'll do a video on that at some point.
Yeah, let's go back up to the earlier chart with the moving averages of the price. So what I would suggest folks do is if this is a swing trading account that you're doing, then I would do something like a 10 and a 21 day on there and make adjustments as you break a moving average, reduce your exposure and increase the quality. Like what we do on the team is we rate each stock that we put on. We'll put an A plus stock on and we'll put a C minus stock on. In some cases, we'll put a D on. There are times where that makes sense. But as you're going through your moving averages coming down through it, so you're losing money and you're going underneath your, let's say, your 10-day moving average, that's when you increase your quality. Say, okay, something's going wrong, either the market or my own trading or both. And then so you adjust. That's your feedback of your market. And so you slow down the amount of trades you're doing, the size you're trading, and you increase the quality. And then as you stay underneath those moving averages, you keep doing more of that. And that's exactly what we did here, and why we wanted to share with you these charts of, this is the model of how to do it, frankly. We're heavy when we're doing well, and when we're doing poorly, but really well on a relative basis, but poorly against yourself, meaning you're underneath your moving averages, poorly above it, you're doing well. That when
Mhm.
you're doing poorly, that you start slowing down, and that's what we did. And you do it to a point where you start getting back up to your averages. So as you said, we made it back above our 10-day. We're not above our 21-day, and when we get it back above both of them, we'll be at more of a comfort level, and we'll loosen up a little bit more. But what you want to do is to slow down when you're in this case, because drawdowns happen, like this roller coaster.
Yeah.
And I've been there, done that. I've got a T-shirt, from it too, man. I've got a closet full of them, and so what we're trying to do is not do that. Is to calm that down, and so it can be frustrating. And I got to tell you, the last month of trading has been the most active, non-active trading I've done, because I'm searching all day long, because I want to put names on the list, but we want to put names on the list, and we want to put the right ones on the list.
Mhm.
But
But you know what I will say,
yeah.
remember folks that there is kind of that other component too, not just what you're doing relative to your moving average lines, but also that relative strength. Because we were below our 10-day moving average line on the equity curve, but we were doing very well on the relative strength. So we were basically kind of getting chips in that way, because you
Mhm,
could see the gap that we were developing between our performance and the S&P 500. That gives us a little bit of, I think, a little bit more comfort to
mhm.
not have to play, when you get a bounce, because it means we can let the S&P 500 come up a little bit and still retain a lot of this outperformance that we've got. So there is that element too, and right now we do have a lot of chips because we've got a big gap ahead of the S&P 500. And so even though we took that hit below our 10-day moving average line, that definitely gave us the signal, hey, be careful. We also at this point have a nice gap above the S&P 500 that does give us a little bit of flexibility to wait, or even to, if we needed to, maybe go a little aggressive because we've got some chips to play with, if we needed to.
Exactly. We will be flexible. I mean, you might see us 100% in 5 days. Like
Mhm.
there's anything is a possibility, because we always keep an open mind. We learned that from Bill. You never plant your flag in the ground and say I'm bearish or I'm bullish. No matter what, you let the facts push you in the right direction. But the last thing I'll say about those is, for those of you who are trading a more orthodox account, suggest having a swing trading account as well as a position trading account, and that's kind of how I do things. And then with a position trading account, you can use like a 50-day and a 200-day, or a 21-day and a 50-day. You don't have to use the 10-day, because it might mess you up in some of those positions to be acting upon a 10-day if you're position trading, because the two don't mesh. So you've got to know what you're looking at. And if someone wants to use a 5-day, I've got no problem with that either. I mean, there's a value in that too. Maybe not for a product like ours, where we're giving out the information to other people and they have to act on it. It might be too many alerts. But for yourself, just use this is a huge advantage, and that's your feedback, that you're getting from the market and relative to the market, as Justin said. And I hope that helps your trading on it. And we're gonna stay very, 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 very flexible.
Yeah. One question that I did want to address, a good one from Sergio in the YouTube comments. Thanks for this, Sergio. He was referring to the 3/11, 2025, the March 11th, and he was like saying, well, how can that be a pink rally day if it closed in the 44% range? You're absolutely right, Sergio. That was not a pink rally day. The rally day was the next day. So this is a little bit of a distinction. So the rally day was the next day, because that was our first day that we were up, but we are still using the low, because that's that discussion that we were having early in the session. This is your rally day low that's up here, and this is your rally low. So we're still using the rally low, even though this did not qualify as a pink rally day. You're absolutely right. It was not up high enough in its range. But this was day one, and that's why Monday, was a possible day 4, but Friday was not, because that was not a pink rally day. So we could not have gotten a follow through day on Friday, much to Mike Webster's happiness.
Yeah, I did not want one. And
Yeah,
another way, Sergio, another way to think of it is the day before as day 0, because I
yeah,
know the terminology of low
mhm,
like it's always so. But the reason why we don't do that is sometimes you can have 2 or 3 days that are your low days before you get a rally day. So then you're
yeah,
like day 0, day -1, day, like there's no non-confusing way of doing it.
yeah.
Um, but yeah,
And part of this came from 1982, August of 1982, where it was you had 4 days that were down, but that was your rally attempt.
let's go.
You know?
Let's go there. I know we're late, but heck, we're not doing this again until April 8th. So, um,
Uh, let's see if I don't know if we have the data going back there.
S&P, and there's no
Okay, let's
volume
let's
on it.
let's see. I'm gonna go to oh, we do. Okay. So yeah, it was the S&P 500, if I remember
Yeah,
correctly. But yeah, here was what we labeled as the rally day, and this came straight from the book How to Make Money in Stocks by Bill O'Neill. This was in the original edition, the first edition. But this was your pink rally day 1, 2, 3, 4, and then you had your follow through day in a very was this the follow through day? I'm trying to remember. I think it
pretty
was.
sure.
Yeah,
Yeah.
1.4%. And then you had a subsequent follow through day here, and it was off to the races. And again, this was in 1982 after, finally the back of inflation had been broken by Volcker and his policies for the Fed. So, yeah, it was an unusual situation where you had 4 pink days and then your follow through day. So
Yeah, and that was the beginning of a major, major
major,
bull
right?
market. Like so, 1966 to 1982 had been this range bound and market, and then from 82, why don't you go out to 2000 on there just to show how big of a move that was from there, and that was a big deal. There was a lot of reasons for that, and the bulk of that, or not the bulk of it, but at least a large part of it, was the inflation situation changing. And then there
Mm,
was some things that we don't have time to get into, but yeah. So it's really important to understand the follow through day concept. I would go back and listen. I think Justin did a perfect job at the beginning of this, and listen to how we explained it a few times if it's at all if you're not sure about it.
yeah. Very good. And hey, thanks a lot again for watching, folks. Really appreciate the support. And you can still like and subscribe that. We will be back April 8th. We'll miss you until then. Peace, and we'll see you next time. Bye bye now.